Hello, welcome everybody. It's your boy Tony over here and we are live. We are live today. It's your boy here and today's topic is going to be economic data trading strategy, all right? Read the market before it actually moves, all right? I've done a lot of these videos all over the place, so if you're new here, you want to ensure that you're having your pen and paper and you're ready to start. Now, there's a promo here if you'd like to get 100% on your first deposit using the Pocket Broker. You don't want to miss that. And before we even start, I have to give you a simple understanding of what exactly this topic is going to be. Now, there are two types of traders, all right? The first type opens their chart. They see big candles. Most times they see candles moving up and down and they immediately jump into moves depending on their strategy, okay? And before they know it, the opposite is happening. The candle starts moving, it starts whipsawing and everything like that. So this particular type of trader doesn't have any idea why it's actually moving. Sometimes the strategy could be nice, but other times there are external factors. Now we have the second type of traders, all right? These are types that already know that the candle was coming, right? It was already coming, but not because they guessed. So there was some bit of information. Now, it could be either they've had about fundamental data or they've read the data before and they have an idea. Now, today I'm going to show you how to be the second type. Now, as much as the second type is better, but still has its nuances, it will still save you, right? Now, timing of this stream could not be better because tomorrow morning, right, we'll have one of the biggest market moving data releases of the year, okay? And we're going to completely dissect all that. So welcome guys to Pocket Broker. I'm Tony, all right, once again, this is an expert of the Pocket Broker and you don't want to miss out on my videos, all right? We do a lot of market breakdowns, market analysis, and a lot of that kind of stuff. So today we are going to cover something that, you know, genuinely changed how I approach the market every single week. Economic data, the numbers that governments and central banks release. We're looking at things like job reports, inflation figures, interest rate decisions. See, most beginner traders either ignore them completely or just panic. They're always in a panic mode. Today, I'm going to show you how to read them before they move the market. What the key releases are, what each are actually meaning for the chart you're watching, and how do you interpret them into a real trading age instead of just sourcing from your impulse, all right? Now that is the psychological part that we'll break down as we move forward. Now today I'll also be giving you a couple of live examples, right, sitting right in front of us, because tomorrow we'll be having some drops of inflation data, and that is one of the most market moving releases on the calendar. So without wasting time, let's get into it. I'm switching to the platform now, right? If you're out there and you're just joining in, you want to make sure that you're using the commentary section and you're asking questions live. Now, before I teach you any kind of framework, right, I want to show you a live market context where we're sitting in right now, because this week is genuinely one of those most data-heavy weeks for 2026. If you look at last Thursday, all right, the US released non-farm payrolls, all right? Now, usually it's released on Friday, all right? But due to, could be bank holidays, it could be because of anything, it was released on Thursday. But the key here is the monthly job report, right? As you're going to see in a bit, the forecast was about 110,000 new jobs. All right. If I open the previous calendar here, let's look at it very well. That was Thursday over here, right? As you could, let's look for that. All right, we had some numbers going on here. Where is that? All right, you want to go check out your calendar very, very carefully. All right, it was the 2nd of Thursday. All right, now if you look very closely here, we see that the expectation was 114,000, right? While the actual came out at 57,000. Now I know that many of the traders out there are looking at these figures, but the way you interpret it consistently with the timing is very important. If you go check out any USD pair on that particular day, right? That was the 2nd. So you want to go and check out the daily time frame here, all right? And you want to move all the way up until Thursday. Usually you're going to find very big candlesticks here, all right? Very big candlesticks that will obviously, telltale sign that something happened. Now, you want to go look at all the affected pairs that are paired to the US dollar. So the actual number 57,000. That is what a data miss looks like, all right? When you're looking at data misses is when the actual doesn't align with the forecast. Now, if you're looking at it from a perspective of a statistician, a 53,000 job gap between what the market expected and what actually happened, we start to see a lot of repricing on any of the pairs. If you go check out gold, all right, or if you go check out the USD JPY, you want to go quickly to the Thursday and see where that gap happened on the daily. All right, so that was around here. All right, we got a drop, and the candles look a little bit irregular, right? They're bigger most of the times, not always, but most of the times they are not more than average. And if you're looking or using an ATR, which is the average true range, all right, you could go over here to the pocket broker instrument list or indicator list, and you want to look for an average true range, right? On a daily, it kind of looks fair, but if you go and check a lower time frame, you start to see the extremes, right? And the average true range will simply tell you how the particular candle that you're looking at has moved in comparison to, say, the last 14. Now, there are some parameters here that you can check. The period, which is 14, that is sort of default settings, and you can tweak that according to your strategy. Now, the point is that fundamental news affect the market. And if you look at tomorrow, for example, if we move to what is up next, today is a Monday. You look at Tuesday, we have core CPIs. Core CPI is the consumer price index. Now, this inflation data will be getting out at 8:30 a.m. that is Eastern time, and we want to calibrate our time with the New York session. All right, it's where the exchanges are, it's where the volume comes in, and you want to have that also right beside your fingertips. Now, CPI, right? This is the last major inflation read before the Federal Reserve meets on July 28, 29 to decide the interest rates. So, if you move forward and look what is going to happen on a Wednesday, by the way, for those of you that are just joining in, you want to ensure that you are looking at the calendar. It doesn't matter where, but for purposes of this, I'm using the Forex Factory. You could go check it out. Wednesday, we'll be having core PPI, producer price index, right? We'll also have the affected Bank of Canada monetary policy report affecting all Canadian pairs. Now, the reason I'm going through this is it's very important to understand the fundamental data and have some kind of strategy before you get into any position, right? Now, I want to go and check out the charts if everyone is looking. So, I'm going to be breaking down why these two releases coming up right after a weak NFP, right? In a week where, say, the Fed is watching every single data point more closely than it has in years. Reason being is we have a lot of geopolitical instability going on, and that is crucial. When you're using the pocketbook, besides any kind of tools that you're using, right? It could be risk management or whatever, but you have to understand this point, okay? Now, this is exactly the kind of environment where knowing how to read economic data gives you a real and genuine edge over traders who just are watching these candlesticks. Now, if you're a believer or if you've been practicing this, drop in the chart right now. Have you ever been taught by a big market move during a news event? Have you ever been taught? You could just put a yes or a no. I want to see who is in the room. That's what today is going to be all about. So we are going to start by sharing with you guys the weekly roadmap. Now, I'm going to start with the roadmap because I feel like it's very important, because even the professionals sometimes are caught off guard. The first tool every trader needs to be using before a week even starts, guess what is it? It is the economic calendar. This is a schedule of every major data release happening that week. All right, like I'm just showing you on the Forex Factory, you get to see all the news releases, and some of them are red, others are just pale gray default colors, but you want to be focusing on the red icon here, right? That shows its high impact, right? So this is the first tool every trader needs before the week starts, okay? The reason is the schedule of all major data release happening that week will give you a heads up before you enter any trade, right? So that when it drops, you are not caught off guard. Now, the releases are usually colored, they're color coded like you've seen. Red for high impact, okay? We have the other ones that are just orange or yellow, right? Those are medium impact. And we have the white or gray, which is low impact, usually safe to ignore, okay? So let's look at this week. This week, I've already mentioned we'll be having CPI, all right? We'll be having, that is tomorrow, something you better be watching. And later on Friday, we'll be having that build into the core PPI, which is Producer Price Index, right? Now, these are not days. These are not days where you want to be just casually in the market with no plan. I don't expect anybody just to jump into any trades. Now, remember last week we broke down an element of risk, right? As much as your risk could be the best, you could still get off your path, and you don't want to have that, right? The market will always teach you lessons. So ensure that you have this insight. Now, here's the most important habit I want you to build from watching today. Every Sunday, okay, evening or even Monday morning, before you open a single chart, open your economic calendar and mark out your charts. That is the first thing you have to do. When you're doing any kind of pre-market analysis, you got to align the week ahead. Know what's coming this week. Know which days are data heavy. Know which releases affect the pairs you trade, okay? For example, if I'm going to be trading tomorrow the US dollar, I got to come over here and check Tuesday. What do we have on Tuesday? We have core CPI. Now, don't get into the details now, right? If you're looking at month to month and why is this Y to Y or M to M, all that will be explained. For today, you got to understand that these high impacts and the time, you got to precisely be able to identify that on the chart. Now, by knowing what's coming up, you are saving yourself a lot of heartbreak. So a quick one before I continue, guys. Ensure that you are using this promo code, all right, to get the best of your 100% bonus, right? That is, if you are using this platform, you will have a bonus. And for all that other information, you could check out the links in the bio. Now, let's go through the 3 data releases that matter most and what each one actually means on your chart, right? So if you're going to master, listen, if you master these 3 and you understand the concept behind them, right? Trust me, you're going to understand 90% of all the major market movements you'll ever see. So the first one is NFP. NFP, again, if you go check out your calendar, we say that NFP came out on a Tuesday, if I'm not, on a Thursday. There you have it. Okay. This right here is non-farm employment change. Okay. Now, what is that? What is that in simple terms? The US job report. Now, if you go to the website, the real website, and I always like, for purposes of comparison, you want to go check out what is actually happening from the website of the government. Now, this is an official government, US Bureau of Labor Statistics, that shares the summary of what is later on put here. Now, there is a difference, and there is a reason why I'm sharing that. It's important, again, not to just understand the numbers, but to understand where they are derived from and how they affect that particular economy. Now, this is the number of jobs that the US economy added or lost in the previous month. Okay, one simple number. If you go check this, it's one simple number. The summary starts with both total non-farm payrolls employment 57,000, right? And the unemployment rate 4.2% changed little in June. The US Bureau of Statistics reported today employment continued to trend up in professional and business services. So you don't have to read all that, but the key here is I'm quickly showing you where to get this data from. The interpretation will come later. Why does it matter much? Why is it so important if you think about it, right? Look, I'm looking at the GBP USD. Now, imagine the numbers came out. The Federal Reserve has 2 jobs. Remember, every country has a central bank, right? Now, in the case of the United States, we have the governing body, the Federal Reserve, right? Now, because the Federal Reserve has 2 important jobs. One is to keep inflation under control and keep employment very healthy. That is the principal job. When employment is strong, the Fed can afford to keep the rates high or even raise them further. When the employment weakens, the case for cutting rates starts to build. Now, we all know that the Federal Reserve is looking to hike these prices. Why is that important? Rate decisions move currencies. That is key. When a rate moves, the currency also moves. That's the chain. The jobs affect the decisions and the Fed policy, which in turn affects the interest rates and then the currencies, all right? So last week was about 57,000 actual versus 110 or 14,000 expected. That's a miss of about 53 take or leave 53,000 jobs. Look at what happened to the dollar immediately. If you go check out the index, you want to go see what is happening with say the US 100, and you want to fast forward that to a daily and actually see the movement, right? We start to see some kind of loosening up here and weakness, right? That is clearly showing a weakness. Remember, we're having some kind of dynamic upward trend. Okay, you want to see this wave all the way from here. Okay, so we're having this area being sort of retested, and we're starting to see some kind of weakness when it comes to US 100 OTC. But that is not the point. Now, because the jobs have reduced, all right, you want to look at other factors, okay? The traders now, who knew that the number was coming or even had any kind of speculative forecast, right? They could have taken advantage of that and placed their trades aligned. Versus the traders who were just watching the candle move, right? And trying to react. You probably got caught in the volatility. Please drop the pair you were watching when NFP dropped the previous week, all right? Just the name. Now, I want to go quickly into what the CPI data is. Now, what is CPI, guys? And why am I just talking about these three economic indicators? Tomorrow we'll be having CPI, and this is actually one of my favorite because it's another big indicator from the same website, Producer Price Index. This is the measure of inflation. Now, isn't that beautiful? If you can tell as a statistician where the economy is going, wouldn't it be nice to get into trades before others, or even months, or depending on your strategy? In the case of a pocket broker, you are positioning yourself and taking out as much juice as possible, right? Now, because you understand CPI is a measure of inflation, how much prices across the economy have risen over the past year. Think of it as an official answer to the question, is life getting more expensive? If you have friends in these countries, you might want to go call them and say, hey guys, what is the price of, milk or a loaf of bread? And there's a special calculator for that, which we call the inflation calculator. And basing off that, you can actually have an informed decision. Let's say you are a momentum driven trader. You are only trading, say, the GBP US dollar. All you got to do is you looking at the daily and you're sort of asking yourself, where is the USD going, right? What is the economy like, right? If you understand inflation, you can position yourself on a lower time frame, okay? We're looking at the 15-minute, right? And your position sizing really well, that is very important. No, if you understand that, why does the CPI move the markets? Remember, it's the same chain as the non-farm payrolls, but we're having a different starting point. When inflation is high, think about it. When we have high inflation, the Fed keeps the rates high or raises them further to sort of cool the economy. Now, high rates equals a strong dollar. What does that happen? What impact does that have to do on instruments like gold? Now, when we have a stronger dollar, there is more pressure on gold. And when inflation falls, the opposite happens. The Fed has room to cut. Rates cuts equals a weaker dollar, hence a stronger gold. Now, if you've never sort of pictured this or ask yourself why sometimes the rates come out or some numbers come out and the opposite happens, all that is part of understanding these economic data. Now, right now, we are in a very critical context, right? Because look at this. CPI is projected at 0.3%, okay? All the way from 0.4%. If I'm to quickly go historically, right? The US CPI, Consumer Price Index, is running at about 4.2% year over year, right? We're looking at this data here. Looking at, where is that? Right, CPI. Apologies, we're looking at year to year. Look at that. 2.8, all right, 2.9. But that is core. That eliminates some of the parameters in the basket. We're looking at year to year, which is 3.8. The previous was 4.2%. Now, we're going to be breaking these down and you're going to understand how important they are, okay? If the US CPI is running currently at 4.2% year over year. That is the highest level since 2023. And you could go check out the history on the same website, right? Okay, you could check out this table here. Will show you the previous years and where we headed. All right. Right now, this context is very important. The Fed's target is 2%. So if it's 2%, why would you be watching the market for certain kinds of moves? The entire market, the forex market or the financial market, are currently watching tomorrow's number, right? With a specific question. Is inflation still accelerating in the US despite whatever is going on around the world? You're looking at geopolitical moves, right? Or is it starting to pull back? Now, according to the forecasts, we are seeing 3.8. It's starting to push back all the way to 2. So, a clean move would be quickly checking out for example, the Euro US dollar. All right, you want to go check out the daily time frame and look at where we are. We are in a consolidation, and you got to ask yourself this question: if tomorrow's CPI comes out higher than expected, it's expected at 3.8. If it comes at high, that means the dollar is strengthening. Hence, the Euro US dollar and other pairs like GBP USD will likely fall because the US dollar is paired. That is the base currency, right? And gold similarly will face some kind of pressure as the real yield starts to rise. So if CPI comes out the opposite, lower, then we're starting to see the reverse happening. We're starting to see Fed is hiking, case weakens, the dollar softens, and the opposite happens to all these pairs. So there are three results that can happen. It could either go high, it could either go low, or it could become, or rather stay neutral. This is the framework before any major data release. You got 3 scenarios for these high impacts. We're looking at either it beats, either it misses, either it lines up with the speculative forecast, right? You decide in advance what each one means for the pair you're going to trade. Now, I have a very simple framework for you, and you could actually use an Excel sheet for those of you that are just joining in. I usually encourage newbies or traders joining in to manually test these figures out, right? Have your simple Excel sheet where you are recording this. Drop in the chat, what's your prediction for tomorrow's CPI? Is it higher than expected? Is it lower? Or is it in line? Okay, I want to check out what's happening with these comments here. Okay, guys, now we're having the third release, which is as equally as important as the rest, which we call the FOMC, all right? The Federal Open Market Committee. This is the third release, right? And we had this over, let's go to the official website. You want to go see this. All right, this is the Federal Reserve Bank of New York. It will show you the economic releases, the speeches, and everything like that. Now, if you want a more detailed one, you want to come to a FOMC speech. Let's look for one. Usually comes out on a Wednesday, all right? So you want to come over here and see what transpired on a Wednesday. And let's see the, remember we changed the chairman. Now we have the WASH chairman who usually speaks. Now you can go and check out some of these from the official website. Now we usually have this. Now this is an example of the federal release, Federal Reserve press release. So what happens is the chair, in this case Wash, he comes out and he sort of reads this. But here's the key. Professional traders are out there monitoring his lingo. You know, there's a certain type of lingo they use, and you got to study that if you want to be a better fundamental trader. How are they bringing this data out? Because one thing is having this data, and another thing is a chair speaking with emotions. You want to understand, is he a little bit hawkish? Is he dovish? So these things are very important, and we're going to be discussing this as we move forward. The Federal Open Market Committee happens 8 times a year, all right? The next one is going to be at the end of July, which is 28th to 29th. So that is less than 2 weeks. If you go over here and you scroll all the way down, right? Scroll all the way down, you're going to see that towards the end of the month, it's very crucial, which is about 28th. Where are you? 28th. There you have it. There you have it. So brace yourselves for impact on the 29th at about 8:30 a.m. Eastern time. Okay. So what does that tell you? If you have an idea of what the Fed will be able to say, right, is going to say, then you can actually start to position yourself. Now, what is the FOMC statement? Remember, the Fed decides whether to raise or cut or even hold interest rates. That single decision will affect every single major currency pair that is out there. Why? Because, take it or leave it, interest rates determine how attractive a currency is to hold. We have investors, we have big banks, we have institutions and everything like that. When we have high rates in the US, it means investors earn more by holding dollars, right? So the demand for dollars starts to rise and the dollar in tandem strengthens. So here is what's going to make these upcoming FOMC statements extra important. Fed Chair Kevin Warsh, who took over recently, made an unusual decision at his first meeting. Remember, he's pro-crypto. He removed what's called a forward guidance. All right, the Fed's habit of telling the market what it expects to do next, no more hints and things like that. So there are no predictions going forward with this current chairman, right? It's just pure data dependent. What that means particularly for the practical realm is every single data release between now and July 29th carries more weight than usual. So CPI, which is tomorrow, PPI, which is on Wednesday, each one is now a genuine live input into whether the Fed hikes, holds, or eventually cuts these rates. So the market will be reading every release as a clue because the Fed itself says it. So that is the difference. And you guys, if you're joining in right now, you are joining in at the best time because boy oh boy, some of us professionals have been waiting for these times. Remember, we are in quarter Q3. We're starting off Q3. You want to look at all those tendencies that could build or destroy your accounts. So now let's see how it connects. If NFP was last week, CPI is tomorrow, and PPI will be on Wednesday, FOMC in 2 weeks. These are not separate events, guys. These are just chapters. Remember, you cannot move currencies anyhow you want, right? You cannot have gold at 2,000 today and then 5,000 tomorrow and so forth. These have to be separate events. And the economy has to move gradually, right? From one space to the other. That is why when you look at your charts on any time frame, sometimes we have consolidations, dynamic consolidations, then we have sort of releasing the steam, we have consolidations, we have contractions, we have a lot of that kind of stuff. So understanding when to get in, when to get out is very important. Now, if you're joining in here, guys, you want to also put in the comments what your thoughts are about the dollar pricing. Do you think the dollar at the end of this year will be stronger or it will be weaker? All right. Now, let us get around how to trade all this information, data, right? If you're looking at a currency pair like, say, say a euro US dollar, right? Step one, all right? what you got to do is mark the event on your calendar. As simple as that. Go to the pocket broker, get the vertical line. All right, get a few vertical lines and mark your territory on the daily. You want to mark it, say for instance, it's going to come out tomorrow at this time, so that between today and tomorrow, for example, you are not making any kind of silly mistakes, all right? You know, you have your boundaries, you understand that between this time zone, something could happen, all right? That is step one. Mark out your areas, right? Everything you do tomorrow should be built around this moment. So I don't expect you to be getting into trades haphazardly unless you have a good expiration, you're understanding your strategy, things like that. Step two is identify a no trade window, right? And this is what I just did. I put 2 lines and I've said between this and this, I will not be entering any trades. Understand 15 minutes before or 15 minutes after, or depending on the way you have you've back tested, you understand that I will not be entering the trade around this time. It could be a simple rule like between 2:15 p.m. and 2:45 p.m. UTC plus 2 tomorrow. That window is closed. Doesn't matter if you get a nice signal, you're going to sit on your hands, right? Why is it important? Well, think about it. Because in the first 15 minutes after a data drop, right, we're looking at this wild, crazy statement here. Let's look at this statement. Where did it go? This statement here. How long would it take a professional to interpret all this? Okay, now I understand there's a lot of software out there and prompt engineering and everything like that can crunch the numbers and give the professionals a side to take. But hear me out. Usually it's about 15 to 20 minutes, right? So that window you gotta stay out. Or if you're just going in, balls in. So once the data drops, the market starts to whipsaw. We get a lot of whipsawing, right? It's very chaotic. You get a spike up, you get candles in both directions. That stop out positions. Now, that is before the real move starts. So traders who get in the spike often get stopped out. And the reverse is true. Spike candles look like something like this, right? If you go to the lower time frames, you can see some of these spikes, you see? Spikes are usually in both directions, right? We want to identify a spike candle here, right? And during these periods, you can either get trapped long or trapped short. Something like this. We get those spikes that can be very hazardous to your overall portfolio. Before the real direction happens, step 3 is after the no trade window, read the 3 scenarios you prepared in advance. If it's CPI, okay, if it's CPI, was it beat? Did it hold? Right? Look for the dollar long setups, guys. Always. You want to also look at the DAX, which is the DXY sort of symbol for the US dollar, right? The index that will show you the direction. If CPI missed, look for what the dollar does. Are there some short setups? Look into the Euro-US dollar, look in some other measures that are affected by the US. And just be patient, guys. You want to be very, very, very patient. It's very important. Don't forget to use this promo code, guys, to get 100% on your bonus using the Pocket Broker. Now, a quick reminder, right? To practice exactly what we're covering today, right? Ensure that you have some leverage, right? You've tested out everything. You've carefully analyzed your risk. If you missed that, go check out my other video on that. And you want to ensure that your analysis and all your setup is carefully aligned, all right? Now, how does that interpret into real trading? Once again, before any data-driven move happens, the chart is going to give you what I like to call a pre-data structure. That is simply like a range between, a trading move, right? The range it's been trading in, you have to ask yourself, was it trending? If you look at this part here, it looks like a consolidation, right? Will price take out the high and the low? That is one, you could say that. If now price is been trending like this, for example, do you think it's going to come all the way down and liquidate some of these positions? You have to ask yourself those kinds of questions, all right? So my advice is don't jump from instrument to instrument. You want to understand maybe 1, 2, 3, 4, 5 instruments very well, right? And only after that you can be able to profit. Okay, so levels are very important. Levels, you want to look for levels where we have buyers and sellers that are positioned. You want to look at round numbers. For example, we have 1.15, right? Those kind of psychological levels is where you want to keep your eyes on, all right? Because take it or leave it. We have traders are just like you, well, human beings, right? We have emotions, we have all these weaknesses, and that is the beauty about this industry. It's very random and purely on supply and demand. So levels matter, all right? And the level that you mark, if you come over here, okay, let's get some horizontal lines there. Okay, if you've marked, say, this on the 30-minute, okay, you've marked, say, where the candle closed and where we got that solid, beautiful run up, right? You want to ensure that when that window comes in tomorrow, you want to have all that identified. Has price reacted? Has price moved out of this consolidation? Is it tending upwards? Is it going down before you even start? So knowing levels, placing your levels at some of these places before tomorrow means you're not making decisions in the heat of the moment. You have sort of back tested and you are projecting, you're having these cases. If price reacts like this, I'm going to do this. If price reacts like that, I'll be doing that. So you're executing a plan you made when you were calm. And that applies to the same. It could be gold. By the way, before I forget, when it comes to fundamental data, gold has a special relationship with CPI data. All right? That is a gem for you. If you're looking at 4.2% inflation, there's a tug of war happening on gold between two forces. We have high inflation, which should inadvertently support gold as a store of value. But if you have a situation where you have higher rates from the Fed, that creates pressure on the gold because it pays no yield. Now, understanding the history of some of these instruments is very important. That is why if we focus on CPI tomorrow, if it comes out hotter, then the second force wins. Gold faces pressure, so you got to watch those levels. Pull out your gold chart here. Pull out your gold chart on the pocket broker, right? And have those levels marked, right? Ask yourself questions. Is gold starting to bounce off my level? If it's bouncing off, then something is happening technically, right? And you want to ask these questions. We'll be breaking down all these case scenarios, right? Map them out before tomorrow. We'll be having more of these live trading sessions whereby you're not just gambling, you are guessing, guys. And this is what reading the market before it moves actually looks like. It's not complicated. It's just it requires doing the homework before the data lands, right? Now, I'll be providing more of these insights. I'll be giving you some of these websites where to get the data from, and I'll be helping you navigate. Understand that we have a ritual, and I want to end with that. There's a ritual that I want you guys to have. I'm going to give you the exact weekly ritual that I follow. I always follow this religiously, and you can also follow starting this weekend. So Sunday evening or Monday morning, before you touch a single chart, okay? Step one, open your economic calendar, flag everything. Red impact, event for the week, know which days the data is going to be heavy. Step 2 is for each major release, write down, get a journal, guys. I've showed you this multiple times. Get a journal. Ask yourself, will it beat, will it miss? Is it going to be neutral? Is it in line with the forecast? One sentence for each. Just write that down in your journal, right? And the more you do this, the more practice you get, and you get used to these things. Step 3 is mark your no trade windows, just like I've showed you today, right? If you're going to have, say, the GBP, right? Or the, say, the Euro US dollar, mark your windows, right? And you can use this website for your time. Very important to show the wild clock. Have you ever asked yourself why most traders have different clocks behind them? It's because of timing, right? You want to understand which continent you're in and how is it calibrated or aligned or correlated with the New York session. That is also important. Now, when you have your windows there, that is step 3, you mark them. You say 15 minutes before and after each red event. These windows are non-negotiable. That is my non-negotiable, right? I will not be entering any of these trades. Step 4 is on the day before the major release, mark your key levels, the levels above or below the current price. That is the whole ritual, guys. Just 4 steps. It takes only 20 minutes. And if you have that for every pair that you're going to trade, going forward for the entire week, trust me, you are going to save a lot of portfolio damage, right? And that applies for every other instrument, okay? The traders who do this every week without fail are not necessarily smarter, okay? You're not smarter than anyone else in this chart. They're just more prepared, and in trading, understand this, I'm going to finish with this. Preparation is the closest thing to an unfair advantage that actually exists. Very important, okay? You might be talented, but you're not prepared. Preparation will always help. I want to end with a live challenge, right? Tomorrow's CPI, I want your call. Use the framework that I've built. Send your charts. Let's discuss that in our charts, okay? And going forward, we'll be having these weekly. So you want to bring in all your questions. If you have anything you'd like to discuss or request, we'll be glad to help you. That's today's session, guys. Let me leave you with 3 things that I want you to remember. 1, it's economic data doesn't surprise prepared traders. Learn the calendar. Know what's coming before the week starts. 2 is have your 3 scenarios ready before every major release. Did it beat? Did it miss? Is it in line? 1 sentence, journaled, 5 minutes of preparation will save you from reacting with no plan. And the 3rd is please respect the no trade window. I know it's hard as a newbie, but you want to respect that. You got to have discipline. 15 minutes before and after every red folder event. The real move comes after the dust settles, not in the spike, right? Tomorrow at 8:30 a.m. Eastern or 2:30 p.m. UTC +2, CPI will drop. You now know exactly what to watch for. If you want to put this into real practice now, okay, on the platform, the Pocket Broker, right? Make sure that you are using this wonderful code. It's going to also help you out. Very simple. You could just come here to top up and put the promo code right there. It will give you 100% bonus. Any questions? I'm in the chart for a few more minutes. Thanks, guys, for being here today. See you next stream. Cheers.